there's no way we can get 16% earnings growth. So the S&P could have negative earnings in 2028. We're not going from 410 to 469. We're going from 410 to 400. Hey everybody, welcome to the long and short of it with me, Rich McDonald, and my mighty assistant, Piers Buckworth. How are you, Piersy?
Your mighty assistant. Wow, that's a demotion. I love that. What a way to kick it off, mate.
The comments last week, we had somebody call you a genius in the comments. I mean, come on, guys. I want you telling him he's wrong in the comments, not calling him a genius.
I just a little copy and paste. Anyway, it's good to be back, mate. Lots of exciting things going on in markets. I look forward to every Wednesday to be able to talk it through with you, mate.
Right, well, let's get going because this is going to be especially important on the eve of Nvidia numbers. We're recording this Wednesday morning, 11 a.m. Of course, Nvidia numbers tonight. Hopefully, you've seen them by the time you listen to this. But we're going to be talking about the circular funding problem. The CapEx boom is here. When cometh the bust? We're going to be talking about all the accountancy measures that are going on, and if this market is sustainable when we look at the EPS numbers and the expectations going forward for the next 2 years. But first of all, we're going to go through the current news and what's happened in the last few days that has caught the eye of Mr. Buckworth, starting with Broadcom. Is the monopoly over?
Yeah, well, listen, that's a good place to kick it off, isn't it, mate? And I wrote my note yesterday, Tech World, to summarize all the important things. And some weeks, particularly recently, it's been somewhat monotonous and repetitive. But then the great thing about tech is that there's always something changing and something critical, and you've got to understand what it is. Otherwise, you're not going to be able to stay on the pulse. And that in the last, last week? I forget what day it was. The latest in quite a long line of announcements in terms of the relationship between Google and the people that they're using to help them build their TPU and all the other functions inside the chip part of the Google business. Up until that point, Broadcom, ticker AVGO, had pretty much an exclusive relationship with Google and a monopoly. I wouldn't say they have a monopoly, because and the chips we're talking about are called ASICs. They're called application specific integrated circuits. And what that means in simple terms is custom silicon. Chips that are made to in a boutique fashion for specific purposes. There's a few companies in the world that do it. Broadcom are the biggest by a long shot. Marvell have entered the game quite aggressively in the last 12 months. And now AMD, who didn't have ASICs at all 12 months ago, whereas Marvell did, are now part of the equation, and they've taken it one step further and have now taken a small slice of the Google business. So what Google did is
isn't this interesting? Sorry to interrupt, Piers, but AMD getting into ASICs, Nvidia getting into CPUs. It's like nobody's sticking to what they are the best at. They want to expand into other parts, don't they?
Well, I don't think they've got any choice, Rich, and that's the beauty of this business that we call technology. You know, people who, I always find it interesting, as obviously engaging with retail people who don't know about markets is one thing, but people who do know about markets and sort of have their just rest on their laurels when it comes to technology. Technology is a moving target these days more than ever. The 12 months ago, it was all about training the large language models with GPU accelerators, specifically the Blackwell chip from Nvidia. Then you move on to the inference stage and the agentic AI stage, and suddenly you've got a whole different stack. You've got CPUs, more compute power, you've got memory, which has become critical, and now you've got these custom silicon chips, which are designed for specific tasks. So if you put them up against a CPU or a GPU, which are very good at what they do, but they're not. They can pretty much do everything, but they cannot be reprogrammed once built, and they're not very good at doing some very specific tasks. That's why custom silicon has become such a big thing that Google, who obviously have ambitions to be able to do all of their chips in-house with their TPU program, have lent into two new partners in this field. And Nvidia, as you just mentioned, have had to pivot as well. I mean, if you'd said 2 years ago, if you'd said that Nvidia would have to pivot away from GPUs and try and come up with their own CPU, you would have been like, well, I mean, those people who follow tech would have been like, yeah, okay, anything can happen, but it was a pretty unlikely outcome. But it's just a sign of the times. More compute power, less latency, more memory, faster, quicker, better. That's what the world wants. And they're all scrambling for market share. They're all scrambling to stay in the game, right? It's not, it's not that easy to, Nvidia stock is in neutral for a reason, right? They're being forced to buy their competitors and their suppliers. They've got lots of new competition. And tonight's going to be utterly fascinating with 100% revenue growth and earnings growth expected by the market.
Right. Okay. So where does that leave us then with Google, Marvell, AMD, and Broadcom?
Yeah. So where does that leave us? First and foremost, let's deal with Google's angle to this. Google don't care who they're really in bed with, although they have a very long-standing relationship with Broadcom, and by no means is that relationship over. But the only difference here is that they're no longer exclusive. They're in a fight. They want the best and the cheapest, and they'll reach out to whoever needs be. The relationship with Marvell is probably the most interesting because they're tied to them now through a warrant deal, $12.2 billion of warrants. For those who are not familiar with what that means, warrants are almost identical to a call option. In other words, you have an option to buy the stock at a certain price in the future. The only difference between a warrant and a call option is that the warrant is issued by the company, and when they actually issue the warrants, that means there's more shares in the circle, which dilutes shareholders. So it's a dilutive impact there. But what it does, the dilution of the stock is something we can talk about another time. For the purposes of this conversation, this is about what the relationship is between Marvell and Google, which is now not only is it very obvious in terms of the business, but the performance of Marvell is tied directly to Google. So they're very much in bed together with that warrant structure, which I think is a really interesting development.
And those warrants are struck at 206 for anybody that is wondering. So $206 per Marvell share. And it took the stock up 6% to start with, but then it rallied throughout the day.
Yeah.
And yeah, we're trading around 235 now. So 15% above where those warrants were struck.
Yeah, again, for the purposes of those who are new to markets and the semiconductor space, this news is fantastic for Marvell, and it's quite good for AMD as well, not particularly good for Broadcom, and that was reflected in the knee-jerk reactions of all those stocks. But once the dust settles, it's not going to change too much in terms of what's going on with these particular stocks right now. They're all quite expensive, in particular AMD and Marvell. They're all quite crowded, in particular AMD and Marvell. So it's going to be choppy trading. So you don't just read that headline and go, okay, that means I'm buying the stock. You've got to take into consideration all the other factors. What's the market doing? What's the bond market doing, which we'll talk about later in this show? What's the positioning? It's what's priced in, et cetera, et cetera. So it's very, very long way away from a black and white situation, but you can put the knowledge in your piggy bank, in your brain bank, that AMD is taking market share. Once again, they did this to Intel. Now they're doing it to Nvidia. Now they're doing it to Broadcom. They're very good, AMD. I love AMD. You were with me from the beginning of that story when they were almost bankrupt. And Marvell as well. Marvell's 12 months ago, 18 months ago, were zero. The market was not even thinking about them. In fact, the market was trying to short them, and now they're dominating, taking market share from the big boy in this space. So take that away. AMD are doing a great job grabbing market share. So are Marvell, and Broadcom are having theirs taken away from them. So I don't want to buy Broadcom for that reason and that reason alone. I do want to buy the other two, but I'm not right now. So that's the point I'm trying to make.
Your analogy at the time when we started speaking about Marvell and the stock was $75 was that they're not on the VIP list. I'm not even sure if they're on the guest list. They're one of these companies that kind of comes along with a promoter to the nightclub. Well, they've got Jensen as a promoter now. So I would say he's the owner of the club rather than just the promoter. They are VIP, aren't they? Yeah,
absolutely, Rich, and it's a really good point. It sounds like a bit of a sort of humorous thing to say, but actually it's a very real point, and one that can help people understand how markets work in terms of this guest list, right? And as you said, when you and I started talking about Marvell, first of all, you thought it was a toy company, right? I mean,
it is a toy company.
Yeah.
It's just a different name.
But listen, Rich is one of the most experienced market people I know, and he's not obviously a tech specialist. But the point being is that's not a joke.
I've never heard of them.
The market in general, like Marvell is part of the GPU accelerator family. So it's Nvidia and AMD, 1 and 2. Everyone knows who they are. Then Marvell is part of that group, but far less talked about. And the stock reflected that too. And then suddenly they burst onto the scene with the custom silicon. And this is testament to that. But in the last 12 months, they've completely burst onto the scene with Jensen Huang. And as you said, they've gone from not being on the guest list to being on the guest list. And what does that mean? That means that the broader market is 100% aware of who they are. Every tier one bank is laser focused on it in terms of the brokerage coverage. And you can bet your bottom dollar that the volume is a lot more than it was, and all the dips get bought. So they get a free pass to a degree.
Well, that was the first thing I did. I sold puts at the 205 level because I think if Google are going to be taking a stake there, essentially, then I'm happy that level is there. So I don't own the stock, but I am short puts, receiving quite a nice premium because the volatility is high. What about yourself? Are they in the book?
No, I don't. I don't have any. The only semiconductor I have in the book at the moment, and it's a very, very short-term trading thing, is SanDisk, which I bought yesterday. And I'll literally, just to be crystal clear, I'll knock this out if I make 5%. That's my thought process on semiconductors right now. I'm in, I'm out. I'm going to trade the volatility, but there's too much going on. The market is rotating away from semiconductors right now. It's trying to process a lot of information, and we'll talk about Nvidia in a minute. But they are the ultimate example, right? The expectations here and what's priced in is significant. And what the market did just a few months ago, which was this enormous euphoric gamma squeezing move higher, has kind of shot themselves in the foot. And when I say shot themselves in the foot, they didn't have too much control over that because the market did it for them. But the aftermath of that is volatile and uncertain, and there's lots of other things going on in the background. So semiconductors for me right now are just very short-term trading, nothing more, nothing less.
If I was going to summarize our thoughts on the semis at the moment and AI in general, it goes along this. AI investment cycle remains alive, very much so, but the effortless phase for traders and investors of buying every single AI beneficiary is long over. So you said in your note, the next stage is about separating profitable businesses from capital dependent stories. So those companies that are taking on massive debt to expand and to buy into the story, you want to find the ones that are profitable. You also want to find the ones that are gaining market share versus former monopolies, like your Nvidias and the monopolies in the market that they were. And then those the cheap compounders from what would you say the opposite of the cheap compounder story is?
Well, and just for the purposes of the viewers, you've got the polar opposite to companies that are being priced off future growth and future expectations are companies that are printing now. In other words, the compounders. And listen, you can break them all down. But just quickly, I just want to touch on what you just said. In terms of in the semiconductor space, the guys that are being re-rated and have momentum, taking market share, making moves, are expensive and crowded, but they're the ones where you want to focus. And those names are Intel, Marvell, and AMD. They're the three major ones, right? They're the three that have come from behind. They've still, if you zoom out on institutional positioning, which is critical to understand, everyone's has been buying Nvidia for years and years and years. It's crowded to the max, right? You can guarantee that. Intel, Marvell, AMD probably a little bit crowded as well, but nowhere near as Nvidia. But Marvell and Intel are not remotely crowded. Like the institutional world, it takes 2 to 3 years of consistent buying and positivity for a stock to get crowded by the institutional world. And we're in year one. Or we're probably just entered year 2 of those two names. Yeah. But so just to answer your question about the compounding thing in this space, right? I just wanted to give one little example. So let's take the AI infrastructure names of Oracle, Iron, CoreWeave, and Nebius. Those 4, right? And I'm singling these guys out because these guys are all about the recurring performance obligations, which is the future payments that are being paid, that the market is trying to price in now. But some of them actually have payments now, are compounding now. Oracle, of course, are trading on 13 times forward earnings. They have a software business which prints money now. So they're compounding now, but they've also got the optionality on the future. Iron is the other one who have a Bitcoin.
You also report tonight.
They report tonight. They have just to be clear, they have Iron have $230 million, which is nothing in revenue, right? But 190 million of that, so basically all of it, comes from the Bitcoin mining business. Now that business is being phased out, just to be clear. Like that, if you think that you're buying Iron as a proxy to the Bitcoin trade, which was the case about a year ago, you're no longer doing that. They're phasing that business out. But they do actually have money coming in the door. Not that it's very much, but that in comparison to, say, a CoreWeave, who are just riddled with debt and are not looking to get any money for a couple of years' time.
Right. Look, I don't want everybody to think that this podcast is all about tech, right? We do look at other sectors as well. The other sectors, I'm going to go through the EPS components of the complete S&P 500, and you'll see why we're so focused on tech. But yes, there are other sectors as well, such as oil, such as pharma. You saw us last week reacting live to that announcement on the cancer treatment that came out from Moderna. But this week, we're going to talk specifically about consumer and discretionary consumer and staples as well. I mean, Walmart had terrible numbers last week. But yesterday, you had your eye on Dick's, didn't you? That came in soft.
Thanks for the pivot there, mate, because I'm a tech specialist and I spend a lot of my time talking about it. Everyone does for obvious reasons. But quite frankly, my focus in this market is not in tech right now. It's elsewhere, as is the market. The market is buying, and again, there's let me create the nuance, but to answer your point directly, there's an underlying theme going on here, which is somewhat being acknowledged by the market, but also being drowned out by the extraordinary EPS growth coming from the AI CapEx story, and of course, what's going on at the long end of the yield curve. But if you look at the data over the last 6 weeks, okay, let's just go through it. We've had two lots of consumer confidence, one of which was yesterday, both of which were pretty significantly below expectations and not great. We've had retail sales, which was a negative print, a massive miss to the downside. We've had a whole bunch of retailers, the most notable of which was Walmart. Walmart's numbers were not that bad, right? They're 2.3% comp growth, but put that in perspective, on a 10-year period, their comps are between 4.5 and 6. So for them to be doing 2.3 is, regardless of whether they beat or miss, those numbers have come down significantly. And if you look at the detail,
let's remember they were on 40 times earnings.
Yeah, no, but they're a tech company, these guys, right? They've got their own, they are.
With 3% earnings growth.
But this is my point. This is what, if you want, I'd like to talk about Walmart. I think it's a fascinating story. They hired this guy from jet.com, right, to run the entire, in 2015. He's now gone. But he did an amazing job turning it into the payments company. You can't use Apple Pay in Walmart, for example. They've got an advertising business. They are very much a tech savvy company, and they managed to get themselves a premium valuation. Consistent comp growth, consistent earnings growth. Even though it didn't contribute a massive amount to the overall number, their tech business within Walmart gave them this multiple. And if you look at the stock of Walmart, like zoom out on 10 years, it looks like a massive tech stock, but it's broken down quite aggressively through the 200-day. And it doesn't look great, if you ask me. But that's one point. But yesterday, and they're the big guys, right? The big bellwether, quite a different business, of course, to Dick's Sporting Goods, who bought Foot Locker. Now, we all know that the sports shoe business, the apparel business is difficult and rocky, and in some places very much so, like Nike, who are having a brand issue and having a consumer preference issue.
Yeah.
But
and Adidas, they've been suffering two profit warnings.
Adidas too, but at least Adidas is still somewhat clinging on to the younger generations in terms of being cool, to put it simply.
Yes, you only think that because you wear them.
No, well, this is actually where we're getting a bit emotional now. I actually just basing this on no one on earth that I know of, especially in China, which is a massive market for them, do they think that Nike's brand is that cool anymore? And that's I literally, the founder of the company, I literally was reading a Bloomberg article before this show. That's a direct quote from him. So you can forget what I'm saying. What about the guy that founded Nike? He said that, not me. So that will that'll put an end to that one.
No, the question is whether Adidas is or not.
No.
But sorry, go on to Dick's Sporting Goods, because it's the whole complex. Footwear is in trouble. That's what they said.
And Dick's Sporting Goods, who own Foot Locker, they bought them about 18 months ago, right? So Foot Locker are the major retailer for Nike. That's one of the things that Mr. Knight did when he came back to try and rescue Nike, is because they'd stepped away from all of their retail relationships. He restarted them all, but they are a critical bellwether and canary in the coal mine for the shoe business. And the numbers from Foot Locker were shocking yesterday. Dick's Sporting Goods was down 22%. Some of the analysts cut their price. Dick's Sporting Goods, by the way, 12 months ago, 18 months ago, was one of the best stocks in the market, full stop. So there's a few things going on here. One, what it says about the shoe business and the running shoe business and Nike's business and Adidas's business. Two, what it says about the general slowdown in the consumer, which goes back to the original point that we're making here. Every single Target was the same, Lowe's, TJX, you name it. All the retail prints have been pretty subdued, if not quite bad. And it's kind of a tale of two worlds, because you've got the consumer, which is clearly slowing down. You've got the labor market, which we'll find out at the next non-farm payroll whether that negative print is backed up. But that's clearly slowing down. Meanwhile, you've got productivity and GDP going through the roof due to AI. So it's a very strange combination of stuff going on in this market and economy right now.
Yeah, this K-shaped economy, for people that don't know what we're talking about there, it's the wealthy against the more working class, and where you're seeing jobs come out of the system. I read even in this country, 50% of graduate jobs have been eradicated in the last couple of years. So people coming out of university, there aren't the jobs there anymore. Yeah. So that is your main buyers of new pairs of shoes every month, and if we continue, this will lead us onto bond yields as well. But if we continue to see mortgages go higher and interest rates in general, then that consumer that has been so strong for so long, do you genuinely think they're at risk?
Well, this is the $1 million question, Rich. I mean, how many times have you and I been faced with the market sentiment, or the question as to whether the mighty US consumer is in trouble? And how many times have the economists called for that? And how many times has that been completely and utterly wrong? I mean, so I'm very, very, very hesitant to try to sort of jump on the US consumer is in trouble bandwagon, and unless we see a lot more evidence. So far, from my seat, and I see everything, as you know, and just all day long, I've seen about 2 months of consistently bad data. If we see 4 months and it's becomes alarming, then maybe there's a bit of a trend forming here. But it's very hard to get your head around, because there's so many. And there's also a big difference between whether the Main Street consumer is getting hit, and these Wall Street companies can continue to make a lot of money and therefore keep the indexes up. So you've got to be careful what you're concluding with a weak consumer. Obviously, if the consumer starts to get really weak and it starts to hit GDP, and then the long end of the yield curve comes down properly, that's a whole different thing. But we're not there yet. So I'm just watching.
There could be a really interesting. It's just before we come off that, I would say I think Nike are really in trouble. JP Morgan came out, downgraded them again, and they're talking about serious problems in the next 2 quarters. So stock almost traded with a 38 handle yesterday. It could get down to 36. I wouldn't be surprised to see it there at all. I
wouldn't be surprised. And also, this may seem like almost a silly or trivial thing, but when you've seen these situations so many times, it's amazing how often this is the case. If you look at where the price targets are, after all is said and done for Nike, the average price target is about 45, I think, which is not that far above where it is right now, right? And stocks in general like to be at least 40% or approximately 40% away from those price targets before they start to bounce. So it wouldn't surprise me at all if we get another bit of news which gaps Nike down again, and that is the moment where you might be able to buy it for a trade. But I've said this to you for a while. I've been trying to buy Nike off and on, as you have been. And so many professionals have been as well. And there's some big hitting veterans in markets and other CEOs of other companies who have got long the stock. Bill Ackman's got a big stake. believing in the brand, believing in the potential turnaround, all this new stuff. But the evidence is stacked quite heavily against them at the moment. Beyond, I don't really know what they can do, because they can maybe buy some Chinese competitors. That would be a sign of weakness, and maybe that would work. But ultimately, the brand...
Sell Converse.
Yeah, maybe they could sell some assets, get themselves a little bit of a bounce in the stock. But in terms of reversing the trend of that they're on right now, I struggle to see how they're going to do that, because consumer preferences are consumer preferences.
Yeah.
So...
right, let's just go through one thing then. And
I actually have a small clip of Nike in my book right now, by the way, just so you know.
I wouldn't.
4 weeks ago you did, so just shush. Keep going.
No, I actually didn't. Again, I'm short puts. I'm short puts at the 37.5 level.
When was
and,
it? I was on the show
cents,
with you. Maybe it was 2 months ago. I was on the show with you, and I was telling you that was no longer long Nike because they were in deep trouble, and you were like, "Nah, I think they'll be all right." And then so now we've completely flipped.
Yeah.
So I've got
Fair.
But this just goes to show you, people who are watching this, right? Both of us agree they're in trouble. Mine is a very short-term, spiky, oversold thing. It's nothing particularly structural about my position. Let me be crystal clear about that. I'm very conscious of the fact that Nike are in a lot of trouble. I'm just playing for a short-term bounce in the stock.
I cannot buy those positions, because there's a day of reckoning coming for Nike.
Yeah.
And that is going to be a slap across the face for everybody that keeps on buying those dips. And it's Nike, it's a brand. Elliott Hill's incredible. They must recover. And if you really listen to what JP Morgan was saying, then that is not even in sight. So it's way too early to buy. And I think the next announcement that you get from them is going to be a poor one. Anyway, what I want to move on to before we get onto this main subject of the day of the boom and bust and the circular funding, I want to talk about the timing of bond yields. Right now, Besant has taken us away from the precipice. Right, successfully, He has managed to talk us down, and the market didn't believe him on Friday, but then it is giving him a lot more.
I think there's a few different forces at work here. Whether or not he has put in place a Besant put, which is, by the way, there's a whole new thing that's just been made up.
He clearly has.
No, I don't disagree. I'm not disagreeing with you. I'm just saying that it also coincided with some significant and pretty poorly publicized developments in the Strait of Hormuz and the Iran situation. We saw oil come off. So I don't disagree.
But he's also in control of that, though.
Yeah, no, I agreed. It's all part of the same thing. Listen, I think that Scott Percent, let me be crystal clear, is a seriously smart, very, very experienced guy. It's not a matter of what I think he is, right? The guy was the CIO of Soros Funds, and he worked under Druckenmiller. Druckenmiller, of course, called him out the other day, saying it was a mistake what he was doing. Whether it was a mistake or not,
that was interesting.
Yeah, it was. I kind of agree. But the thing is that going back to your point is that whether you agree it was a mistake or not, it doesn't matter. What matters is it working? And he's basically threatened that he will use $1 trillion of the USTR, which is essentially the US Treasury bank account, which has got $967 billion in it, by the way, at this moment in time.
Yeah, it's a rainy day account for anybody that doesn't know.
Yeah, but he threatened him to use the whole thing, right? So some of the stuff that's being said is quite extraordinary. But what he has done is made the bond market think twice. And basically, as you just said, put a bit of a put under the market. You can see at the long end that it's, which is very crowded, by the way. One of the reasons why I'm long TLT, which is the long bond ETF. It's very crowded.
Also long TLT. Well, that's interesting. So when did you buy that?
Last Thursday.
Yeah, that was the first thing I did as well when I saw the headlines.
Yeah, I actually bought it 2 days before he did that, because my view is not, I got lucky with Scott Percent or not, because it went straight back up to where it was before anyway. But my view is that Iran will move on, oil will come down, inflation, and ultimately the Fed will either have to raise rates or there'll be enough economic pain. Either way, the long end is coming down, which means TLT is going to go up. And it's also very crowded. If you look at the options positioning, by the way, in TLT, it's aggressive. Like call options in that thing are actually alarmingly big. Have you seen that?
Well, my biggest position is short puts on TLT, because I'm at a level where that means that the 20-year yield would be 5.5%.
Yeah.
Right? And I think he will defend that to the hilt. So I'm short puts there. If I know that a Besant put is in the market now, he's not letting the 20-year yield go to 5.5%. Therefore, TLT is not going there. Therefore, I can be short those puts. To me, that's the no-brainer trade.
It's almost too obvious, Rich, isn't it? I mean, but you've got a hedge fund manager in charge of the treasury. That's quite unique. When I say quite unique, that is the only time that's ever been the case. And so he thinks like that and he acts like that. And look how interventionally this guy intervened in the yen, which hasn't been done since 1998, and then intervened in the bond market, which in the fashion that he did it hasn't really been done before, quite frankly, if you consider the fiscal state. I mean, in 2002, they kind of did it, Yellen and Bernanke, there were kind of things here and there. But the way he's doing it and the kind of person that he is this is a whole new thing for the market to consider.
Right, quick word about Friday then, about Jackson Hole. Can Kevin Warsh get into bed with Besant as well, or is it going to be a completely different message we get from him in that he's going to let the market decide prices going forward and not manipulate them?
Well, again, I think I love this conversation. It's so much more interesting than stocks and tech because this is the good stuff and the stuff that people truly need to understand. Macro right now is everything. You need to understand it. Macro is controlling why gold's doing what it's doing, why emerging markets are doing what they're doing, why everything is doing what it's doing. I think that there's going to be, I think there will be market volatility, but I think it'll be very, very small. I don't think Friday is going to be this big fireworks thing because I don't think he's going to change his narrative.
Okay, so you don't think Nvidia really has an effect on the market tonight? You don't think Jackson Hole has a big
potentially
effect?
They do, but I don't think they will.
We think bond yields are under control, so it sounds like the market's gone higher then next week.
No, I don't think that either. I think exactly the same thing that I've thought for the last 3 weeks, which is, by the way, has been exactly correct, which is that the tech is going to continue to trade in a range and be heavy, and the market will continue to rotate where possible, albeit some of those things are becoming a little bit overbought, into these other areas, whether it be consumer, value, et cetera, et cetera. So I think basically the entire market, banks, of course, are a bit overbought as well. I think the entire market is going to consolidate and be range bound. And I cannot see what the catalyst is to change that unless we see a significant shift in the inflation situation.
Okay, well, that takes us perfectly on to today's big subject of the day. And that is, of course, what everybody's been talking about. It's front page of Financial Times. So the actual subject isn't a shock to anybody, circular funding. But let's break it down and let's get into the accounting methods and the EPS numbers that go in to make up the S&P 500. Okay, so what I would like to give everybody a little bit of a backdrop of what is this EPS number that you speak of when it comes to the S&P 500, because it's not the company's headline EPS number and just add it up together. It is, of course, the weighting as well.
So Rich and I have been talking about EPS assumptions in the S&P 500 for many, many years. And it's an extraordinary situation that we have right now because not only are they the expectations for this year, which are 300, were they 355, Rich?
Yep, 300, exactly.
355 for this year. And that's moving to 405 next year, which for the S&P 500 has never been seen before. But it's the concentration and the composition of that we want to talk about with you today. Should we break it down, Rich?
Exactly. So let's look, and we'll put up on screen here the top dozen companies. And that starts with Nvidia at $31, right? So what that means is that we say 500 companies in the S&P 500, we put all their earnings together. And of course, when you've got an EPS, then to get the value of the S&P 500, you attribute a multiple to that. And the multiple we can go on to in a different week. But traditionally, that was about 17, 18 times. And then in the last few years, post-COVID, it's gone up to 21, 22, even 24 times. But what we're doing is we're putting all the EPS together and then putting it on a multiple of between 20 and 22 times. And that gives you this S&P 500 total of 7,650 as it is at the moment. So let me take you through the company by company component of that. Nvidia is $31 of the 350 odd of EPS estimate. Then it goes Alphabet 21, Micron 18, Microsoft 17.5, Apple $16, Amazon $13, Broadcom 10, and Meta 8. All AI related names, or tech. Apple's in there as well, of course. But that is just so dominated by tech world. In fact, the first time we get down to a real world company is a Chevron or an Exxon that contribute $4 or $5, an Eli Lilly that contributes $4. So, 12 to 15% of what Nvidia contributes to the total S&P 500 earnings. And of course, that total S&P 500 earnings is what dictates whether the S&P 500 goes up or down.
And that's after adjusting for the weighting, right?
Exactly. So Nvidia is 8% of the S&P 500, something like that.
Exactly.
So that $30 is 8% of the total.
Yeah, because we were talking about this before the show, and I just thought I would mention it because it's the similar principle to the market cap weighted or the equal weighted S&P 500. But just to be clear, Micron's actual number for next year is $155 a share. So it's astonishing, and the point of this entire conversation is that we've never really seen such concentration of this magnitude, and therefore such reliance on one specific corner of the market to hold up the entire S&P 500. And it's going to be very interesting to see whether the next 12 months whether these numbers can be achieved. I think, Rich.
Well, and not just achieved, but we're talking about the expectations, right? So at the moment, we're trading at 7,650, the S&P 500. So that's on 21.7 times the earnings. So 21.7 times Nvidia, $31, Alphabet 21, Micron 18, etc., etc. Next year, right, for 2027, we're expecting 16% earnings growth and that EPS number to go up to 410. And then in 2028, we expect another 14% earnings growth and the market earnings to go up to $469. That is insane growth levels compared with where we were 5 years ago, even where we were in 2025, right? It is not sustainable. It is the boom. And the question is when the busts come. So let's talk about circular funding. And Piers, maybe explain what this term means for everybody.
Oh gosh, it's such a big subject. But circular funding is quite. It's best described. I mean, there's these beautiful big webs which have sent round all over the retail and professional world, which have OpenAI and SoftBank and Nvidia basically at the center of them, and then all the different little hands and tangents off. And there's about 50 companies on the ecosystem, and they're all centered around. And by circular funding, I mean, take the relationship, for example, between OpenAI and then its core ecosystem, which of course is Oracle and AMD and Meta. Make it those three. So Meta, AMD, Oracle, and OpenAI. Right? OpenAI don't have any money. Right? They're broke. They're not broke. Let's not use that inflammatory term. They don't have any money. They've got revenue, but their expenditures are miles beyond the money that they have, and therefore
they're loss making.
They're having, just like everyone else, they're having to build. Even Google are moving to negative free cash flow. So all of these companies, no matter how good or how bad, are having to raise money in the most inventive and creative ways that they've ever had to. The debt markets have come alive. The CDS markets have come alive. And the basic issuing bonds, fine. Issuing equity, fine. Swapping stock with the other guys, promissory notes and promises to do this and promises to do that. If you actually delve into the relationships and the back and forth promising and swapping around of money and off balance sheet funding, which is what a lot of these guys are doing. There's like $1 trillion of funding that's been raised by these companies that's not even on their balance sheets and profit and loss statements. Which is just I mean, that's a whole different subject on its own. But the creative accounting, the swapping of stock and swapping of debt, it's a mind,
exactly. So that's what we're here to do. We're here to break this down. So let's look at some of this accounting measures, right? Now, remember, Nvidia at $31 of the S&P 500 earnings is hugely important, and it makes something like an Eli Lilly or a Chevron, Exxon irrelevant, really. Whether they increase earnings by 10% or drop 10%, it's irrelevant compared with Nvidia's number at $31. Now, of course, where is Nvidia's earnings coming from? It's coming from the hyperscalers that are investing in their AI build out and spending all the CapEx. What happens in the accounting world when CapEx is spent is that it's depreciated over between 4 and 7 years, right? So the $1 billion that Google spends today on chips, or whoever's buying chips from Nvidia, the $1 billion that's spent is not recorded today as an expenditure of $1 billion. But for Nvidia, it's recorded as revenues. So all those revenues are in that S&P 500 number today, but the expenditure isn't. So every time that the hyperscalers are spending money on chips, it's imaginary. All the revenues are coming as profits and all the costs are coming over the next 5 years. Right?
Which is precisely Michael Burry's problem with these guys, yeah.
Hugely. Now, what happens with all the money that Nvidia is making, right? Huge boom in cash flows for Nvidia. Well, they want to guarantee that the companies are able to continue buying the chips. So what they're doing is they're going and taking investments in some companies. Piers, what's Nvidia invested in? Marvell?
What are they not invested in? I mean, these guys have got stakes in pretty much all their customers, some of their competitors, Lumentum, Coherent, Nebius, CoreWeave, Marvell, you name it. I mean, they've got, and that's just to name, they've probably got 50 different listed companies that they're invested in.
So let's look at the accounting methods of that, right? An investment doesn't count as a loss against your business. So Nvidia is investing the money, it's not spending it. Therefore, it doesn't come off their EPS. However, the company they invest in is then taking that investment cash, and part of the agreement with Nvidia is that then spends on buying Nvidia chips. Nvidia recognize it as a revenue. Straight away, it drops into the EPS. So the S&P 500 gains again. And it doesn't just gain from Nvidia's earnings getting better. It gains from the company who has received the investments, share price going up because Nvidia's bought a stake in them. There are so many components of this that are just mind-blowing, that are creating this earnings bubble in the short term. How can that be sustainable, Piers? How can we still be expecting 16% earnings growth and then 14% earnings growth when we've got that bubble?
Yeah, I mean, listen, but I just want to complete this point. So, and all this off balance, and there's so many different ways that these guys can account for this stuff off balance sheet. You know, they set up special purpose vehicles. They do sale and lease back, operating leases. There's about 10 or 15 different creative accounting and structural ways that these guys can account for their debt off the balance sheet. And as you just said, there's creative accounting ways that they can account revenue now, despite the fact it's actually in the future. But the one point I would make about this is that, and this is very important for people to note, I think, is that the entire structure of the stock market, the entire structure of accounting practices, stock-based compensation is a great one, non-GAAP EPS, all this kind of stuff. It's a rigged game. Everyone's 401ks are in the market. No one wants the market to go down, least of all the people who run the show. So it's a rigged game. So we just accept that from the start, from the get-go. But the problem exists if something happens that is out of control of the people who are rigging this game. And that is cost of capital. These guys, this is the ultimate debt circulation we've ever seen. The bond market is telling the US government, stop spending money. The stock market is telling the companies, stop spending money. And they're going to continue spending money. If they manage to pull this off and they get the return on investment and inflation remains somewhat under control and the discount rate is somewhat under control, this could all be pulled off. If that discount rate becomes a problem and or one of these circular funding things blows up, this is going to be a huge disaster. But the accounting practices and the games that are played are human nature, and they're part of this rigged system. So I don't think we can sit here and talk about them till the cows come home. They're never going to go away.
But it's more the timing, right? And this goes back to my days at Credit Suisse, right? You got your bonus deferred. So you received half your bonus. I'm going back to when I took voluntary redundancy, so 2016. So let's say my bonus for 2015, you receive half in cash, and then the other half is spread over the next 4 years. Okay, now that's the same in my eyes as the depreciation of these chip investments.
Yeah.
Now, that's fantastic until you stop earning. Now, I took voluntary redundancy and I went backpacking around South America for a year and a half. So I wasn't earning, but I was still receiving my deferred bonus. And because I had them from 2013, 14, 15, and then 16, then the largest part of the bonus was actually in 2017, and then it tapered off. So I had enough to enjoy backpacking and got a private room in a hostel rather than in the bunk beds. Now, all these revenues that are coming through at 100% of the value today in these quarters, the CapEx spenders, the hyperscalers, are having to pay for them in ever bigger amounts because they don't have CapEx expenditure in any great scale from 2024. They've got a little bit from 25, but they've got a hell of a lot from 26, 27. So you're getting the part from 26, 27, and 28. You're getting that for the next 4 years. Once you get each tranche, 25, 26, 27, 28, on top of each other, it's massively negative for earnings. In the 2027 and 2028, 2029 years, there's no way we can get 16% earnings growth. So the S&P could have negative earnings in 2028. We're not going from 410 to 469. We're going from 410 to 400. So what multiple do you put on that?
I think that there's the counter argument to that is, look, and I think this is really important to note, right? Warren Buffett is quietly fading off into the distance, but he's quietly also making some really important comments, like saying Berkshire. He doesn't really have much say in what happens in Berkshire Hathaway, but of course he probably does behind the scenes. Those guys are doubling down on Google. Why are they doubling down? They're doubling down on the one company that everyone else is having question marks over, because they're doubling down on the company that's spending the money, because they've seen this game before. You don't buy the companies. You don't buy the picks and shovels, because that's like a sugar rush and it collapses. It's the ultimate example is memory. You buy the companies that are investing, if those companies are investing in the right place. So the EPS that's currently being forced into the picks and shovels and being sucked out to a degree of the guys that are spending that money. The question remains, if this turns into a massive cash cow for them and they actually do deliver what they've promised and what the whole market is expecting, then that EPS will flip back to the people that have spent the CapEx and be sucked out of those other guys. And guess what? Those people are much bigger than those people in index weights. So I could see a scenario where earnings remain somewhat elevated, but going back to your point, the chances of them remaining up where they are now are incredibly slim. So I can't see any outcome other than we have a pretty significant drawdown in the market at some point in 2027 leading into 2028.
Okay, so let's do this. 2028, I'm going to say a company, and you tell me whether you think their earnings will be higher or lower in 2028 than they are next year. 2028, are they higher or lower? Nvidia.
Lower.
Alphabet.
Higher.
Micron.
Miles lower.
Miles lower. So that's the third biggest contributor to the S&P 500.
Yeah.
You think is going to be miles lower. And we still expect the earnings to, I mean, come on. Microsoft's tough.
Microsoft is a tricky one, but I think that, listen, I think Microsoft, Meta, all these guys, the Magnificent Seven names, to take Tesla out of it, are currently in a tricky spot, right? But if they're spending their money, as Warren Buffett said, in the right place, in which these people aren't stupid, right? They're not just spending trillions of dollars for the fun of it. If it turns out that this is a profitable business that they're investing in, then the EPS will flip back to them. But one thing is certain, and that is that the guys that you're just talking about, the guys that are having the sugar rush now, are all going to have a massive collapse in earnings. That is a guaranteed. It's just a question of when. Over the next 3 years, not if.
And that's why we're calling this.
And that's why they're called.
Now we've got the boom. When's the bust?
Exactly right. I mean, but I just want to give the nuance to that. I don't necessarily think that I don't necessarily think there's going to be a bust. There may be, there may not be, in terms of what these guys are investing in. But the companies that are dealing, Micron's the greatest example. $155 EPS for next year. The chances of that being anything but, I mean, that's only going down from there, right? This CapEx.
Exactly, that's the peak. Yeah,
that is the peak. And the CapEx. Listen, Goldman Sachs. They're out talking about how CapEx is going to go up again next year. Let's assume, for argument's sake, that they're right, that CapEx gets raised again on the earnings calls for these guys in 2027. Let's give them a lot of optimism here. Let's say that they raise it quarter one and quarter two. When we get to quarter three and quarter four, in my view, the chances of them still raising, it will be a cutting CapEx thing back there when we get to that. So if we make it to then, the question is, when does the market start to price that in? And I would say not far from now. I think it might already be doing it now to a degree.
Goldman's estimate that CapEx has to go up again next year.
Yep, that's what's in their estimates.
That's what's in their estimates, yeah. Whereas you think that it peaks quarter two, quarter three next year and starts to come lower.
Yeah, I'm not. They might be right. We might get another earnings season. Forget this year, because I don't think anything's going to be cut this year. When we get into next year, quarter one earnings calls. Here we go. What are we going to hear? Are we going to hear them raising their CapEx again? I would be shocked, but I wouldn't rule it out. Whereas when we get to the second half of next year, I would rule it out. That's my point.
The estimates are definitely for it to keep on going up.
That's what the market is assuming. And if you listen to what Goldman says, and this is how simple this game is, and quite frankly, it's disappointing. The head of Goldman Strategy was like on CNBC the other day, and the journalist was like, "Why do you think that CapEx is going to go up next year?" And the response was, "Because the companies have told us that."
Yes.
So, okay, great. Well, that's the end of that conversation.
I'll give you one more. I'll give you one more problem for the likes of Alphabet.
Yeah.
And that is that their stake, Amazon and Alphabet this year, their stakes in the Anthropics and OpenAIs and their investments, they've taken a gain on those investments, right, mark to market. And that has been a huge beneficiary of the S&P 500 EPS estimate. So that $352 includes one-off massive gains for Alphabet and Amazon. But we still expect there to be 16% earnings growth, even though those investment gains are not going to be there next year. Or if they are next year, it's got to be a different investment. And then they've got to be there again the next year. So we're actually talking nearer to 18% earnings growth next year.
I just think the risk reward in the stock market now, equity risk premiums down to 4.2. You can bet, and you can only get, there's only 20 companies in the world that are paying dividends more than the risk-free treasury yield, right? Where's the? It's just not that.
Say that again. 20 companies.
Yeah, that are paying dividends higher than 4.7%, which is what you get for free.
out of 500.
Yeah, exactly right. So, I mean, listen, and that's just that component. Never mind the equity risk premium, which of course is the S&P 500 plus growth, plus buybacks, plus dividends divided minus the risk-free rate, which is in a healthy scenario, you look for that to be above 5 at least. It's now 4.2, which historically is very, very low. Now, listen, these are all traditional, textbook ways of looking at markets, but to me, there's so much priced in. The risk is to the downside, not the upside. The pain trade might be higher in the short term, but how much higher? I can't imagine it's too much higher.
And I think a conclusion for this could easily be the S&P 500 is not where you want your investment nowadays.
No.
The Nasdaq's not where you want your investment. You've got to find something else that will be the story of the next 3 or 4 years.
What about China? I mean, listen.
Too risky.
Yeah, you say that, but okay, just the emerging market basket has lots of interesting. Brazil, I mean, but you say, but okay, I mean, we're running out of time on this show, but the Chinese tech market is trading on 12 times earnings. That's half the price.
Yeah, you can't take a serious investment like the S&P 500 and put your money into China. We're talking more about those, longer term, your core investments in your life that you want 6-7% gains on. We're talking about the S&P 500 could actually.
What about Japan, mate? What about Japan on 13 times earnings? There we go.
Yeah. Emerging markets, ex China, ex Korea, could actually be interesting. Like you said, Brazil, Japan, maybe India comes back to growth.
Brazil also, they're dealing with complete opposite situation to America in terms of their massive inflation fighters. They did it early, right? They've got rates up at 14.5. They've got inflation at 9s. But they're at the other end. So they're going to be cutting rates quite soon. So the macro environment in Brazil is actually quite strong. But it's emerging markets is where it's at. If in terms of, but again, you've got to the macro has got to be in play for that. US dollar's got to stay somewhat under control. But yeah, listen, it's a tricky one, mate. Portfolio composition at this moment.
Right, tell us, where do you think the future investments are? Or do you think we're wrong? Do you think the S&P 500 keeps on trucking and that 469 EPS estimate, which is up, 170, is up 33% from here? Do you think the S&P 500 will be earning 33% higher in just 2 years' time? Let us know if you think that's, or where would you put your money? Piers Buckworth, it's been an absolute pleasure.
Mate, it's a pleasure as always. Thank you very much for listening, those of you who are, and we'll see you again next week.
Peace.